Hey, welcome back to the show. Total Financial Solutions Safer Money Hour. Arif, Halaby, and Jeff Girard. We're talking about 401k plans. Now, Jeff, a 401k, what does that mean? What is the 401 parentheses K? What is that all about?
It's a really cool name for the place that you can find the rule in the IRS code. So the 401 is basically the area, and the subsection is K. That's why they put it in parentheses, which just basically says that if you're a for-profit entity or company, basically any company that's not a hospital or a research facility or a school or a governmental agency, anything that's a for-profit company, they are allowed to have a company-sponsored plan. Now, that means that they choose who they have provide the plan, provide the benefits. It's basically like a group benefit, and they pay some of the fees, and they tell you the rules around it, tell you if you can borrow money, can you not borrow money. So they have all the little things there that go along with that. So that's basically what it is. It's an arrangement between a company and the IRS that allows you to put money in before you're taxed. Now, you'll notice that when you get your pay stub, you'll see that you had a gross amount, which is the amount of money that you earned based on your salary and your hours or however you're paid. And then you'll see some line items before you get your money. You'll see maybe some health insurance deductions, some payroll taxes, yada, yada, and you'll have that 401k deferral, right? Now, that's a deferral because you're sending money off. You're saying, don't pay me. Send that $100 or $200 or $500 or $1,000 each paycheck. Stuff it in that account before you pay taxes. And then that's a really nice thing. And that's how people reduce some of their taxable liability throughout the year.
Now, part of the 401k genius, if you will, is that it comes out without you even seeing it.
That's right.
They played the same game that the IRS did. See, the IRS used to say, all right, and it was only the top 1 or 2% of American income earners that actually paid income tax.
Right.
So what they would say is, okay, how much did you make? Fill out a form, and if you will, and oh, you made this much money, you owe us $1,000. Well, the guy or gal would come up and say, I don't have $1,000. I spent it all year. The IRS said, this is like the 4th year in a row you owe us money. So what they did is they said, look, we're going to take employers who were good at doing what they did, steel manufacturers, railroads, I'm trying to think of back in those days, newspaper makers, all of those folks. And they said, you're now also going to be a tax collector. So they went to those employers, required them to withhold money before you ever saw it. So you would make a certain amount of money per hour or per week or whatever. They would pull the tax out and you would receive the smaller amount. Well, the 401k companies in the 70s came along and said, that system seems to be working. We don't even have to worry about people coming in every year and saying, okay, I want to give you money. So they said, we're going to go directly to the employers and say, you're already a health insurance company, because now you got to pick the health insurance, best one for your employees. Really? Right. Why don't just let the employee pick their own? I don't know. I don't get that. Well, if I have a company that is a great auto manufacturer, what the heck do they know about retirement planning or manufacturing my health insurance? That's different, right? But that's the way the system works currently. So the employer contracts with that 401k company, with the investment company, and says, we are going to take out of the paycheck, and they pick a number, and you pick a number, but it's before you ever see it. Here is the most important information on retirement you will probably have all year long. Maybe your entire life. Are you ready? This is so darn important, I cannot tell you. I looked at numbers this morning. It doesn't matter as much the mutual fund or investment that you choose as it does the amount of money that you contribute on a regular basis. Let me say it again. It doesn't matter as much as the investment or the mutual fund that you choose, as much as it does as how much you contribute on a regular basis. Here's a good example. If you start out at 5% of your pay when you're in your 20s or your 30s, but you move it up 1% every year, it's not very much. But the difference, if you are putting 5% in and you go and you add 1, people say it's only 1%. No. What is 1 of 5? That's a 20% increase. You have just increased your retirement contribution by 20%. That's huge, you guys. You would take a 20% pay raise. I would. All of us would. That means that every year you save just a little bit more, until you hit the maximum. And then you continue to save a little bit more until you find that, there are different types of investment or retirement choices. You find those and you work with your financial professionals to figure that out. But the goal is to do the number one thing, and that's the contribution. The second most important ever is the risk or the loss of principal. Now, you can save up $1 million, lose $300,000, which people have done, 30% in 1 year, and that sets you back a decade because it takes a long time to make up that money. Tell you one more time. The second most important thing for your retirement is the loss of principal and interest, the loss of money that you have set aside and that you have earned. That is very important. Because you can have the day before you're ready to retire and you're still at the same risk level that you were if you were in your 30s or your 20s, lose a big chunk of money and you got to start all over again, or you can lose a decade. So be very careful of the objective. And the third most important thing as you're building your retirement, especially your 401k, it's a 4-letter word, starts with F. Get your mind out of the gutter, people. It's called fees. I added the S to make it a 4-letter word, fees. The amount of fees that you pay in your accounts can eat up the returns significantly. And I want to give you an example. We had a client with their retirement account. The fees they were paying over the course of 7 years, it happened to be 7 years, she had I'm going to be close on the numbers, but it was about $136,000 in the account. And it had grown in 7 years to 147. That's not bad. She's in her early 50s. Look, we all want a lot more money, but that's not bad, okay? 136 to 147. She made $11,000. We looked at the fees that she was paying. The fees that she was paying in that same period of time was about $27,000. That means the broker and company and however they separated it, it's up to them. They made $27,000 and she earned $11,000. Now, what if it was the other way around and she put $27,000 in her pocket? Now she has more money earning interest. Now she can retire with a bigger chunk of money. But a lot of the financial companies will kind of dip in there and take a piece of your money, whether they earned it or not. So those are the top 3 things I want you to be careful of, okay? Contributing each and every year a little bit more. Start out low. That's not a problem. You can do that. But every month, every paycheck, every day, you save something. The second, it's the risk. Make sure you're not losing the money you've already worked for. You can't go back. 3 years ago, the overtime that you worked, the money that you put into your retirement account, you can't go back and say, hey, I want to get those hours back and spend that time with my wife or my kids or my husband or my children. Can't do that. Nope, it's over. But they can take the money that you made from that, can't they? And then the third way is fees. I don't mind if you make me $10,000 and I give you 1 or 2. If that's the deal, hey, I'll take that. I worked for the big chunk of money that's earning this interest. I'm taking all the risk. But you made me the money. Let's split it. I'm okay with that. Maybe the number is, if you make me $10,000, I'll give you $3,000. Maybe that's the number you agree on, whatever that is. But why should I pay you more money over the course of 5 or 10 years than you made me when I'm the one that took the risk, lost my time with my friends or family, that worked for this money and now it's gone?
Well, that's incredible. So many people lose sight because they're in that treadmill of just going to work, sacrificing their time, sacrificing that money. That's out of circulation for you. You don't get to go buy a new pair of shoes or a purse or a new car for whatever reason. You're not putting that into a car payment or buying a rental property or something like that. You're putting that into your 401k or your retirement plan. And the sneaky little thing, and I say sneaky with hanging quotes, it's just the way it is right now for a lot of folks. I'd say a broad majority of people have their eyes closed to this, these fees are coming out in little payments, whether it's quarterly or monthly, however it's, or they think, oh, you know what, my employer's paying all the fees on this. Really? You think that they're going to make, spend their money so that you can have a plan and you can just walk in and go, hey, I'm just going to put money in and there's no risk or fee for me? Trust me, it's there. And I think we just get kind of locked into what we're doing because look, we're working, we're spending our time, trading our time for compensation, trying to make a lifestyle for ourselves, hopefully saving something for the future, and it just falls off the radar. I can't say it a better way because we get so busy doing what we are supposed to be doing, which is our profession, our career, our calling, and now we're supposed to be these, savvy investors and watching all of the fees and all the little underlying things. That's just not how it goes. So checking in with your financial professional, having a team. Arif, how many times have we said have a team?
That's right.
No matter what you think your net worth is or lack thereof, having some semblance of a team is probably the one of the other keys here to making sure that those other three things are in order.
And you want people to work together. You want your investment, mutual fund, stock person to work with your safer money person. You want those two to work with your bank if there's questions. You want all three of them to work if you have an attorney that has a trust, and you want them all of them to work with your CPA or your tax advisor. The reason when I say work together, it may be a 2-minute conversation. How much can I put down for their retirement accounts this year? Okay, thank you. It may be a full 2-hour lunch meeting. It may be, hey, help me complete the forms that I need to transfer the beneficiaries. What should I say on the forms, Mr. Attorney, since they're the ones that did the trust? Give me what that information should be so that I can, in turn, complete the paperwork, right? Everybody has to be decent. They have to be mature. They have to be adults. I'll give you a good example. We spoke to one of the investment professionals recently, but because the client was taking a big chunk of their money and moving it to safety, they're now in their late 50s, retiring soon. They want to start moving some of their money to safety. This person thought it was theirs. And I said, no, you're still going to have a big chunk of money. All we're doing is we're moving some to safety. You just said you guys couldn't do these types of programs. You're not licensed for it and you can't do it. So that's what we do. And they said, well, they weren't very nice. And I said, I don't know if you want that person on your team anymore. You have to decide why they are acting the way that they are. Is that in your best interest? I don't know. So this is a part of the plan. Your 401k is a piece of that puzzle. But you can roll that 401k because it has the same tax strategy status into an IRA, an individual retirement account. That transition, that move over, is just a few forms, really, a few pieces of paper.
That is, and you gain some benefits on the side that we talked about, which is you may have some different, and in fact you do, in most cases, have much more ability to move your money in different places. So if you wanted to buy things that you couldn't buy with your 401k money, you may now have the ability to do that because an IRA has typically a lot more options, but you don't get to borrow money from your IRA. So if you think, oh, I'm just going to take it from my old 401k because I couldn't take a loan, move it to my IRA because I can borrow there. That's not how it works. And we talked about that. If you think you might need to borrow from it for whatever reason, as long as there's a plan, as long as you have a strategy in place for something gainful with it, and then an ability to pay it back in a timely fashion so you don't get eaten up on fees and interest, that may be one of the things you can do there. But rolling it into an IRA, it's basically a place where you're going to start collecting. Now, you may leave this second job, right? Or this third job, whatever number this is for you. And now you have another 401k with some dollars in it. Maybe there's 5, 10, 20,000 in it. Maybe you've socked away a whole bunch of money and you say, what do I do with this money now? Same idea. You can continue to take old 401ks, and we've done this for a number of clients. They may have, 5 or 6 old IRAs, 401ks, just money that's sitting out there that's off the radar, and they want to open up a new IRA and start to bring dollars into that. Maybe that's to build up an income bucket for them. Maybe it's to preserve the principal and make sure that they don't go backwards, or maybe they're reducing some of their risk and their fees. So this is the type of vehicle or the type of arrangement, I should say, rather, where you say, I'm going to start stuffing some of those old retirement accounts in here, and I'm going to watch this. This is somewhat of a consolidation move, and I think it makes sense for a lot of folks that have had money in various places, and they get closer to retirement. They don't want to manage all that, so they want to bring it to one or two or maybe even three places, and now that IRA is a pretty simple place. Now, look, the word IRA, it's an acronym. It doesn't dictate the fees, the risk, how the money grows or doesn't grow. It's a function of what the IRS looks at as far as those dollars. If I have $20 and I want to go deposit it into a savings account at the bank, let's say, and I want to take it out tomorrow, the bank says, sure, we'll take $20 from you or $100, and you come back tomorrow and you want $100, no problem. However, if I open up an IRA and put money into it, or if I've put money in an old 401k and rolled that into the IRA, and I want to take money out, they're going to ask me a few things. Number one, can you fill out this form, please? Number two, are you of retirement age? Is this a qualified distribution? There's a whole host of things in there, and you may just say, you know what, forget it, I'll let my tax guy figure that out, my tax guy or gal. However, you can take the money out. Just know that it's not the same as putting money in a savings or taking money out of a savings. It's the arrangement between you and the IRS. So it's an important part. There's some rules around it, but you do have some access, and I just want you to know that, because that's really the rule around the dollars that go into an IRA.
And part of what you're doing when you're building this as piece of the puzzle is know that if it's a 401k and it goes into an IRA, we call it a traditional IRA, when you pull these funds out, they're taxed as ordinary income. So it's wherever you live, whatever your tax bracket is, whatever your write-offs are or are not, that is how you pay taxes on this money. Whether you live in California. And look, I'm going to tell you, a strategy a lot of people use is to move out of California.
Right.
This is incredible to me that the state of California continues to shoot itself in the left foot and the right foot and then break its left arm. It seems like it's doing everything it can to chase out business owners because they think that the policies that they're enacting are beneficial. They are not. Look, I understand this whole thing, but if you now are retired and you earn $8,000 a month in income, and you can leave the state of California and put an extra $600-700 a month in your pocket by not paying California income tax, do you think people will do that? $600 a month?
It's a lot of money.
That is a huge paycheck. That's a free car. If you leave the state of California, you get a free car the rest of your life. And I don't mean just any car. I'm talking Mercedes, BMW, Lexus, one of my favorites, an Acura. Do it. You want to leave? You get to buy yourself a brand new Acura every 3 years. People do that. So they're not the ones that are taking jobs. They're making jobs because they have retirement money to spend. They're not out working. They're using their retirement savings to spend. That's the best kind of folks you want. You want folks that are not taking a job and making money. That's fine. We want that. But I'm saying that this is the other side, which is even better. Folks that have a lot of money and are just spending it. Why do you think Florida goes crazy? Because you have a lot of retirees down there just spending money. Whatever they do, they're not taking a job. They're creating jobs. So if you're on the other side of this, how do you scare those people away? We're at a net loss of nearly $60 billion in wages in the last 15, 20 years.
Wow.
Gone out of the state of California. Wages that cannot be taxed. And it's going every single hour. Two of my friends just moved this year so far. In the last 3, 4, 5 months. Gone. Taking their income, their wages, and gone. So part of that challenge for you and I is when you're now retired and you're going to be thinking, what do I do? A lot of folks are choosing strategies to retire to Nevada or Texas or Florida or Alaska or Wyoming, states that do not have income tax, Tennessee, and they're leaving the state of California for that reason. You can keep a vacation home here, and some people do, so they come back and visit their church friends, family, whatever. But their residence is in Henderson, Nevada, or Reno, or Dallas, or whatever, Texas. So that's a strategy people use. I'm not encouraging it. I'm telling you it's just the way it is. That is a traditional IRA. When we come back, we want to get into the nuances of a Roth IRA and how does that work with your 401k when we come right back. Total Financial Solutions Safer Money Hour. I'm Arif Halaby. That's Jeff Girard. This is your place for news, talk, and information. Remember, you can go to hometownstation.com, click on Total Financial Solutions, and you can get a chance to watch our videos. That's what we're doing. And also read articles about what we're talking about here and send us an email, your comments and questions. We'll be right back. Total Financial Solutions Safer Money Hour. I'm Arif Halaby. Hey, welcome back to the show. Total Financial Solutions Safer Money Hour. All right. We're talking about, on the Safer Money Hour, your 401k. Now, sometimes 401ks are not in safe places, meaning they can go up and down and people can lose principal. They can lose some of the money you earned. So when we bring up the safer money choices or what that's all about, sometimes that means you have to leave the 401k world. Even if you're still working there, you can actually take out the money that you've already set aside, you've already matched, you already earned interest, and take out a portion of those funds and roll them over, eliminating some of the risk, lessening your fees, if not eliminating them altogether. And in some cases, taking those funds, putting those in safer money options, still continue to contribute to your 401k, still receive a matching, still continue that. All you did is you just took out the chunk of money that's already there. That's an option a lot of people are using as you are in your 40s and 50s and 60s, getting closer to retirement. You want to start, taking the cream off the top and moving that off to the side, if you will, and building up that account. One of those options is to convert some of those funds or put those funds even directly into a Roth, R-O-T-H, Roth IRA. So what's a Roth IRA?
Well, the Roth IRA was created some time ago as a means to put money into an IRA. So it's basically the same type of thing. You put money into an account, and the government looks at it like, okay, this is a retirement account, no problem, except the money you put into a traditional IRA, you can deduct that in a lot of cases. You got to check with your tax professional, but you can deduct that. You do that for the deduction now, and then down the road, you're taxed when you take the money out. The Roth IRA, you put that money in now. It's kind of like putting money into the savings account. There's no tax benefit today, but qualified distributions, that means that when you're in retirement and you've had the account at least 5 years and you're over age 59 and a half, for most people, you can start taking the money out. The money you put in, the interest that it earns, tax-free under current law. So why do we say under current law? Because it's been on the chopping block a couple of times during this administration. So we'll save that for another show. But just know that this Roth IRA concept is a means for you to get out of the tax man's pocket. It's a way for you to have money come out of your accounts, give you retirement income that is taxed differently, which in this case is not at all. So let's say that you're in a 25% tax bracket. That means basically a quarter of what you're going to take in as income, you have to give to the government in federal income tax. You wouldn't have to do that with a Roth IRA. Now, why is that important? Because let's say you want to live on $100,000. How much money do you have to take out? 100? No, you'd only get 75, right? If you take out 100 from an IRA or a 401k, you would probably net, in my example, 75,000. With a Roth IRA, you would take out less money. That means you're depleting your savings less. Oh, and by the way, you don't have to pay the tax man on that.
The Roth IRA is often used as a way to get extra funds out of your retirement account at a later time, but you have to pay tax today, meaning you do that conversion, or if you take some of your traditional IRA and you start dripping that into the Roth and doing that slow conversion into that Roth, as Jeff was saying, those funds later on are never taxed. Well, why would you do that? What's the purpose of it? It's used often for people to keep their retirement account, their income below certain thresholds. So when you talk with your tax preparer and your advisor and you say, hey, how do I manage this so that I do not end up having to pay taxes on my Social Security? Your CPA or tax advisor will give you a number and say, don't make more than X. Well, what if you want to live better than that?
Right.
Does that mean all of us have to just stay poor or pay massive taxes? No. You could actually have your Social Security not taxed and at the same time live very nice and comfortably by pulling money on a monthly basis from your Roth, R-O-T-H, Roth IRA. So if today you have a lot of tax write-offs, your children are young, you might have business write-offs, this might be the time to start converting or moving some of your money over into safer choices and reducing of taxes. You you have to think about this for a minute, because this is where the strategizing comes in, and where the working together with your insurance professionals, your financial professionals, your retirement professional, all of those people should have or should be on the same page as to whatever the objective is that you're trying to achieve. And the safer money part of that, that's where we fit in. So if that works for you, great. You can always come in and talk to us. But the part of the challenge is, how do you sit down and make sure you are not paying taxes twice on the same money, or messing up by having risk and fees, so that you're always starting the race 10 steps behind the starting line. That's pretty crummy.
Right.
There are things that you can do along the way to kind of mitigate some of that.
Now let's go back to the beginning of the show with our conversation of the old 401k. Remember that money you didn't know what to do with? If you have, like Arif said, tax write-offs, if you can absorb this, remember rolling over that old 401k into an IRA? In most cases, you have that option to roll it directly into a Roth IRA. Well, you might say, well, look, that's fantastic, Jeff. That's wonderful, but I'll pay the taxes today. Let's say you put $20,000 away in your old 401k. If you take all that out and cash it out, or put it into a Roth IRA, it's the same thing. What some people are doing, and they're having success with this, is, in Arif's example, they've got a year where they can absorb a little bit of extra income, and it doesn't really make a whole lot of sense to look for more deductions. They might say, look, I can convert a little bit of that money into a Roth. If you have $20,000 or $100,000, you can convert as much or as little as you want into that Roth IRA. So what do I mean by that? You would just do a rollover each and every year. Some people use 5, 7, 10 years to get all of that money from the pre-tax side of things into the post-tax side. It's not like they took a big chunk of money and now they have to give half of it to the government. They did it in little increments. And maybe one year they said, oh, you know what, your tax guy or tax gal says, you know what, this year let's not convert too much, or let's not convert any at all because you made too much money. And then the next year kind of evens out. Let's roll over a little bit more into the Roth. So systematically, you're moving some from the pre-tax to the post-tax side. Why is that important? Very simply, we have seen people save so well and save so much money all in the pre-tax side that they actually got punished for saving too much money, I would say. I mean, how else do you say it?
Yeah, of course, because part of what your strategy should be is to lessen taxes. Look, all of us want a healthy country, military. We want the roads to be fixed. We want to make sure we have good air traffic control, the police and fire and nurses. We get it. But if there's a way to kind of lessen the taxes that you spend a little bit more, or maybe to make it, to even out the playing field, all the presidential candidates have, different ideas, then that's great. Let's move towards that. But meanwhile, you still have to take care of you. And that's a strategy that should never change, regardless of your political affiliation or your ideas or the situation of the country. You still have to take care of you and your family. That's what it's all about. So that's what these strategies are beginning to talk about. So let's break it down on the final option. Your old 401k, if you took it and you cashed it out, as Jeff was saying, you're going to pay taxes, but you'll also pay a 10% penalty.
Right.
If you convert it, you pay taxes, but you don't pay that penalty.
Great point.
If you roll it over from company to company, it's called a rollover. So 401k to an IRA, a traditional IRA. So it goes from the 401k company to the IRA company. No problem. That occurs. No taxes, no penalties, no fees. The releasing company where you used to be may have a $25 or $35 fee or something that they are doing for no reason, but they just do. So they may have that, but there shouldn't be any taxes, penalties, or fees. Move that over, comes over, it's a new place. Another strategy that we brought up is the 401k transfer to your existing. So your old 401k comes to the new company that you're working at. Why would you do that? What's the purpose of that? It's usually because you may want to borrow money, but there are rules associated with that.
That's right. And we've talked about that. There's a maximum amount of money that you can borrow from a 401k. So in this example, if you have this new 401k at this new job, and relatively new, maybe 2 or 3 years, and chances are you've been maybe putting in 4 or 5% of your pay, maybe 6% of your pay, getting a little bit of a match, you can only borrow that much. But the old 401k money that you had at that other job, you bring that over, now you've really bolstered up that amount of money, and chances are your new plan is going to allow you to take a loan against the entire amount of money, but you have to check with your HR director on that.
Yeah, that transfer that can occur where it goes from 401k company to the 401k company, the main purpose of that is the borrowing. That's the reason that you're going to do it. But once you have $100,000 in your current 401k where you are working, because you can't borrow from an old 401k, you only withdraw, which is a taxable event. But your current 401k, if you have $100,000, then that's the limit, because there is no more borrowing benefit after $50,000, because that's the legal limit, $50,000 or 50%, whatever's lower. So if you have $30,000 total in your retirement account, you can borrow $15,000. If you have $500,000, you can borrow $50,000. That's it, period. If it's $100,000, it's $50,000. That doesn't change. Okay, so just know that that's one of the reasons that you would do that. And then you might take the rest of what's left once you hit that $100,000 and move it to a safer choice. You can do that. That's part of the strategy. That's what you might do to reduce the risk and the fees. And remember, our top 3 things that can cost you or make you the most amount of money in retirement. Number 1 is increasing the amount every single year. It's the contribution. Even if you have to start at 4 or 5%, you add 1, maybe 1.5%, 2% every single year. The second is risk. Having your money grow to a certain amount and then losing it just the month or the year or even a couple of years before retirement is very dangerous to you having the growth that you expect. Additionally, number 3 is that F word. It starts with an F. It's 4 letters. But it's fees, F-E-E-S. And when we say fees, they can be high.
That's right. We've seen it to where the company, the brokerage, the brokers, the agent, everybody else that was supposedly managing your money, they've made more money than you when you were the one that sacrificed your time, didn't spend that money, you saved it. You put it at risk. You're hoping to hit a home run. Maybe you did or didn't. That's irrelevant. We've seen cases where those companies have made more than the person that actually put their own dollars at risk. So be aware of that.
Yeah, part of the idea is that you should be making more money during a period of time than your broker or your agent or the company. This is your family's finances. You have to protect it. You have to watch out for it. Nobody else will do that. Please remember that as we take the steps to plan for your future. This is a beginning. Thanks for listening. I'm Arif Halaby. This is Jeff Girard. We're here every week at this time talking about your family's finances, of course, getting out of debt and managing money. And you can always find us at hometownstation.com and click on Total Financial Solutions. Thanks for listening. I'm Arif Halaby on AM 1220 KHTS.